And it isn't just earnings and the dollar on investors' radar this week. We also have the Fed decision, by the way, on Wednesday, the April jobs report on Friday. So for more on all of what this could mean for markets and stocks, let's bring in BMO's Chief Investment Officer, Young-Yu Ma. Young-Yu, thank you so much for joining us. I mean, obviously, we've got a lot of economic data on the calendar. Recent economic data, we saw some surprises with the GDP number, for example, but then the PCE came in pretty much bang on. What are your expectations this week, and which economic data point is most important to the equity market?
Yeah, it's great to be here, Courtney, and definitely a lot of data this week. We do think that probably the most important thing will be some of the under the hood numbers with the jobs report. We actually think when we look at hourly earnings, when we look at labor force participation, we think that's going to set some of the tone for whether or not the market thinks that the inflation pressures will ultimately be on a downward trajectory over the medium term, or if we just face a very protracted battle, which Chairman Powell is probably likely to point to in his messaging on Wednesday. So we do think there's a lot of data that's going to come out. The Fed will probably be signaling a little bit of hawkishness to the markets, and the markets might reprice a little bit the prospect of actually having no interest rate cuts this year.
Wow. Yeah, obviously we've gone down from 6. And so we are far away from those initial expectations. We're almost at the end of April. When you put everything together, when you're looking at the economic data points, do you think it's going to be a sell in May type of year?
We don't think so. We don't think that's what's advisable here. We actually think the growth drivers are in place for the second half of the year. We think corporate spending is starting to pick up, and that will be a big driver for the year. And we think that as long as inflation can remain relatively stable, that the investors in the market can focus on that growth and profitability that's starting to improve. And we can overall see a favorable trajectory, but we are going to have some push and pull because the more growth we get, we'll probably see some upward lift in those long-term treasury yields, which is just going to cause some tension in the market. So it's not going to be a straight line, but we do think ultimately that growth is going to win the day and provide a healthy backdrop here.
Young-Yu, it's Tim. Thanks for joining us. So maybe that's framing the answer to my question, which is you're a CIO, you're managing risk, you're thinking about allocation. Seems to me that the market has kind of decoupled with the reality of not 5 cuts, maybe not any. And so do you think that? And do you think that changes the thesis for equities here?
It's definitely not a Goldilocks scenario anymore. I think it does change the backdrop. We don't expect the markets to just be this constant grind higher. But I think that overall, if we think about how do we want to allocate risk, we still want to have a healthy allocation of risk, and we still want to look for areas that we think can outperform. But no, it's no longer the Goldilocks scenario of having falling inflation, a Fed that's cutting rates aggressively, and strong growth. That just wasn't going to last for very long.
So you heard us hopefully had a conversation about the Bank of Japan and yields, and you don't have to agree with us, but how important are 10-year yields? And, I think we're on the way to 5%. The market doesn't seem to care right now. Should it, or where will it?
I do think it's important. I think the market will start caring if we start knocking on the door of 5%, and certainly if we get beyond 5%. We hit 5% in late October of last year, so there's a little bit of experience we've had now with 5% that definitely jarred the markets at that time, perhaps caused the markets to be a bit immune to another trip toward 5%. But I think that if we do get a push past 5%, that's going to be much more of a wake-up call for the markets that that level that we reached before could be surpassed and perhaps substantially. So we do think it's a big risk in the markets here, and it is something that we think the markets are going to be very sensitive to the 10-year Treasury yield over the next few months.